Hello, everyone, and welcome. Just so you know, this explainer was prepared by Dr. Samir Al-Rashani with AI support, and today we're jumping right into the really fascinating world of international accounting. Let's get started. All right, today we are deconstructing giants. We're going to explore how international accounting standards, specifically IAS 16, tackle the huge challenge of accounting for massive, complex assets. Think about things like airplanes, container ships, giant factories. Assets that are really more like a collection of different parts than just one single thing. So what is the core problem we're talking about here? Well, it's that these huge assets, they aren't just one solid piece. They're made up of so many different parts, and each of those parts has its own lifespan, its own way of being used up. This is the central puzzle that the International Standard for Property, Plant, and Equipment, what we call PP&E, is designed to solve. To make this real, just ask yourself, how in the world do you depreciate a cruise ship? Seriously. If you just treat the whole thing as one single asset with, say, a 30-year life, you're missing the whole picture. The ship's hull might last for 30 years, sure, but what about the engines, or the high-tech navigation systems, or even just the furniture in all the rooms? Each of those things has a totally different lifespan. Depreciating the ship as one lump sum just doesn't reflect how its value is actually consumed over time. It's kind of misleading, right? And that right there is the fundamental issue. These complex assets are really systems. A plane has its airframe, but it also has engines and all the cabin interiors. A factory has the building itself, but then you've got the assembly lines, maybe some specialized robotics. Every single one of those parts has its own unique, useful life. And if you treat them all as one item, you can really warp a company's financial statements because you're not correctly matching the cost of using a part to the time period it's actually providing a benefit. So what's the fix? Well, under International Financial Reporting Standards, or IFRS, there's a much more precise method called the component approach. And listen, here's a really key difference you need to know. Under IFRS, using this approach is mandatory for significant parts. It's not optional. Over in the US, under GAAP, it's only permitted, not required. And that right there creates a pretty big difference in how companies around the world account for these exact same types of assets. The component approach is, well, it's pretty much exactly what it sounds like. You take a single large asset and you break it down into its significant parts, its components. Then each of those components gets accounted for all on its own. It gets its own price tag and its own depreciation schedule. The whole idea, the entire point, is to get a much more accurate picture of how that asset's future economic benefits are really being used up over time. So how do you actually do this? Well, it's a pretty logical four-step journey. First, you've got to identify what the significant components actually are. Second, you figure out the cost for each of them. Third, and this is the important part, you depreciate each component separately over its own useful life. And finally, step 4, when a component needs to be replaced, you take the old one off your books, that's a process called derecognition, and you add the cost of the new one. Makes sense, right? Okay, theory is great, but let's see how this thing works in action. We're going to use an example from KPMG to walk us through the rest of this. So, meet Shipco. They're a company that just dropped a cool $400 million on a brand new ship. The question is, how are they going to apply this component approach? First things first, they've got to allocate that $400 million price tag. They figure the ship's body is worth $200 million and the engines are worth $120 million. But look at that third component, dry docking. Now, that's not a physical part of the ship at all, is it? Nope. It's the cost of a massive, legally required overhaul they have to do every 3 years. So that $80 million cost is treated as its very own component and depreciated super fast, over just 3 years. This is a perfect example of how component accounting can handle both the physical and, well, the not-so-physical parts of a huge asset. Okay, so we've got the asset, we've broken it into components, but the accounting fun doesn't stop there. Now the company has to decide how they're going to measure the asset over its life. And this brings us to a major fork in the road, a big policy decision. Under IAS 16, you've got two paths you can take, the cost model or the revaluation model. The cost model is pretty simple. You just stick to the original price and depreciate it from there. It's stable, predictable. The revaluation model, on the other hand, is way more dynamic. You're constantly updating the asset's value to whatever its current market price, its fair value, is. Now, here's the crucial rule. You have to be consistent. A company has to apply the same policy to an entire class of assets. You can't just revalue one building but not the others. For that class of assets, it's all or nothing. The cost model is pretty straightforward, so let's zoom in on the more complex and, frankly, more interesting one, the revaluation model. What actually happens when you're living with revaluation and the market value of your stuff starts to bounce around? The standard itself, IAS 16, gives us the main rule here. It says revaluations have to be regular enough that the value on your books isn't materially different from the real market value. So what does that mean in practice? Well, for something stable, maybe it's every 3 to 5 years. But if you're talking about assets in a really volatile market, like certain kinds of real estate, you might need to do a revaluation every single year.
All right, let's walk through an example. So a company owns an asset, and because they chose the revaluation model, they call in an appraiser. And the appraiser comes back with amazing news. The value has shot up. So how do you record that gain? So the asset's value jumps from 30,000 euros to 40,000 euros. That's a $10,000 gain. But, and this is a big but, where does that money go? It doesn't go on the main income statement, and it doesn't boost the company's profit for the year. No way. Instead, it gets recorded in the separate section called Other Comprehensive Income, or OCI, and it builds up in an equity account called the revaluation surplus. You can think of it like a special holding area for gains that haven't really been cashed in yet by selling the asset.
But of course, we all know markets go down just as easily as they go up. So let's imagine that the very next year, that same asset gets revalued again, only this time its fair value has tanked. How does the accounting handle a loss?
Okay, so the asset's value now plummets from 40,000 euros down to 25,000 euros. That's a 15,000 loss. Here's the deal. It's a two-step process. First, that loss has to cancel out any previous gains that are sitting in that special holding area, the revaluation surplus for that specific asset. We had a 10,000 euro surplus, right? So the first 10,000 of the loss just wipes that out. Gone. The remaining 5,000 of the loss, that part gets recorded as an expense on the main income statement, and that actually reduces the company's profit for the year. So we've bought the asset, we've broken it down, we've measured it during its life, and now it's time for the final chapter in the story. What happens when the asset is sold, scrapped, or just retired? This is all about getting it off the books and, just as importantly, telling the story clearly in the financial statements. The fancy term for this is derecognition, and it's really just the official removal of that asset from the company's balance sheet. This happens for one of two reasons. Either the company gets rid of it, sells it, for example, or it just decides there's no more economic benefit, no more value to be had from using it anymore. And figuring out if you made a profit or a loss is super straightforward. You just take whatever cash you got from the sale, then that proceeds, and you subtract what the asset was worth on your books at that moment. Its carrying amount. The difference is either a gain or a loss, and that gets reported right on the income statement. Simple as that. You know, at the end of the day, all of these complicated rules are about one thing: transparency. IAS 16 forces companies to disclose a ton of details so that investors can actually understand what's going on with their assets. Companies have to tell you if they're using the cost or revaluation model, what their depreciation methods are, and they have to give you a detailed breakdown of how their asset values changed all year. And that level of transparency is absolutely essential if you want to make a smart investment decision. And that really brings us to the big final question, doesn't it? The component approach, these revaluation models, all these detailed disclosures, they're all designed to paint a more accurate, a truer picture of a company's financial health. But is there a point where trying to be so accurate just creates so much complexity that it actually makes it harder for an average investor to figure out what's really going on? And that, right there, is the big debate at the heart of accounting standards today. Thanks for joining us for this deep dive.